Today we're going to explore why dividends are such an important component of your returns. On the slide in front of you, there are 4 key reasons that we're going to work through as to why this is so. First of all, dividends are an extremely reliable source of income for you. Also, the amount of dividend that you receive is actually completely independent of what a share is actually priced at the time. Dividends can also act as a safety net in times of volatility. And the final main point to get through to you is that capital gains can happen in share markets over periods of time, but large corrections or negative price movements can take away 2, 3, maybe even 4 years of capital return in a single year. But your dividend or income returns, they remain in the bank and cannot be taken from you. Let's have a look at this graphically. What I've done here is I've taken a chart of the ASX 200 indice. That's the blue indice in the chart sitting behind me. That has actually increased about 8% over the last 3 years. The red line is actually indicative of not only that capital return of 8%, but the dividends that the top 200 businesses have paid out over the last 3 years. And that actually increases that return from 8% to about 25%. And what that means to you is about 70% of your returns from the Australian share market over the last 3 years has actually come through dividends. So it's actually quite a large component of your returns. Now, looking forward, were the share market to fall 10% tomorrow, that 8% capital gain would be wiped out pretty quickly. And now that we're in the recovery phase of the economic cycle, bull market corrections of 10% or 15% should be expected. In our economic updates, we've talked about the greater volatility that comes in this phase of the economic cycle. However, the markets may fall 10%, but the dividend income that's paid to you is completely independent of that. Your income will remain the same. And the income that you've received over the last 2 or 3 years will remain in the bank and cannot be taken from you. I've worked this example back 8 years, and you can see in the chart behind you over the last 8 years, capital returns have been about 20–25% in the portfolio. But when we count the dividend yield over the last 8 years, that returns comes up to 80%. So it's still the case that 70% of your returns over 8 years are being delivered to you in the Australian share market through strong dividends. So when the average return of the Australian share market over the last 20 years is about 8.1%, and when we've built high yielding portfolios for you averaging, say, on a gross basis 6 to 6.5%, almost 80% of the returns that we're expecting for you will actually come through dividend yields and franking credits. And this cannot be taken away from you. But it's important to realise as you look at your share portfolios on a year after year basis, that capital growth that we expect to average, maybe only 2 or 3% a year, is not building up in share prices. So you're seeing very lacklustre numbers sometimes after 2 or 3 years in the Australian share market. Indeed, some of the volatility can take a few names in your portfolio down by 10 to 15%. But when we're looking at averages over a large period of time, we haven't seen Australian shares move up a lot. The power of dividend yield comes over time. After 5 years on a 6% income return, you have received 30% into your bank account. Over 8 years, those returns almost average about 50% for income alone. And what we say over a 5 to 8 year period in the share market is if we have had some good years, then we do expect capital gains of 10% or 15% to be sitting there in your capital accounts. But it's really that high income yield that gives us the patience to sit there and wait for that long-term performance to come. What's also obvious when we look at international shares is international shares do not have the high dividend yield that Australia has. So the MSCI index is your common average globally accepted as world stock market returns. When we look over the last 3 years, the MSCI index has returned about 20%, and with dividend yield has returned about 26%. So that's the red line versus the blue line. But you don't see the large gap between that income and the capital growth. Were a correction to come to global share markets and wipe out 10 or 20% off stock markets, those 3 years of returns would be completely wiped out, and there would be very little income left in investors' bank accounts. And this is one of the reasons why Australians tend to have a large bias to Australian shares, because the income returns are about 3 times or more what global income returns are from shares, and during corrective phases with income you get to actually hang on to those returns, whereas with large corrections in international shares, all that performance is lost out of the share price, and sometimes very quickly. You can see on the chart behind me, in February alone, global markets fell about 10% in the space of 2 weeks. So, the amount of dividend received, and I've mentioned this before, is not impacted by the price of the share. Let's just explore that quickly. In any business, there's an amount of earnings or net profit that come through, and the dividend level is actually decided by the board based on the earnings they received that particular year and where they think the future earnings are going. And boards deliberate that at least twice a year, every year. The share price of a particular security or stock has no effect on that decision by the board at all, nor does the price of the security or stock have any effect on the level of profitability of the company coming through. So although a share price might be moving up, or although a share price might be moving down, the level of dividend stays the same. It doesn't change. So price does not dictate income in the share market, and that's very important to you. That's actually registered on this chart behind me. So volatility in share prices is very large, and over the last 20 years, annual volatility in share prices can be measured at 12.5% or more. But volatility in income is very small. Over the last 20 years, income has only moved about 1% per annum. So that is why dividends and income are a much more reliable source of return to you, because share prices are often traded at the whim of markets at the time. So we've seen before that if Trump launches a trade war, or there's problems in North Korea, or wars, or there's questions about China growth, in our past economic updates we've given you countless examples of how volatility in markets were created. Greek bond crises, Brexit exits, these sorts of things have not economically brought down the world, and we've seen share prices recover and heal after each of these events. But through all this, income was very consistent, and income grew steadily and slowly. So that dividend income can also act as a bit of a safety net. If share prices are moving down and income is the same, then the percentage income that people are being paid when they're buying at lower prices increases. As a dramatic example, if a stock at $100 is paying a 3% dividend, and if it falls to $50 and income doesn't change, at that $50 share price, the income yield is now 6%. So you can see as share prices fall, high dividend yielding securities actually become more and more attractive. And that's the safety net that we're talking about. It's that relative dividend attractiveness that tends to bring in buying support and see the share prices of high dividend paying shares recover. So, as a final point, we are aware that the Labor surplus franking credit proposal could be taking away gross dividend returns in the future. It can actually franking credits can make a difference of about 2% per annum. So just be aware that Morgans and a lot of the listed investment companies, for example, that you may have investments in, are being very active with government bodies and lobbying groups to see that the franking credit proposals remain very similar to what they are today.